India has produced over 100 unicorn startups, generating massive amounts of paper wealth. But these billion-dollar valuations are often hollow at the center. When it comes to cutting-edge manufacturing or original R&D, the Indian startup ecosystem remains decades behind the US and China. Instead of funding original breakthroughs, the market is geared toward rubber-stamping copycat business models. Investors are pouring billions into repeating formulas that already worked in the West, while sectors like deep tech and artificial intelligence struggle to find even basic support. This creates a steep human cost. Take Bugworks, a biotech startup that discovered a new way to fight antibiotic resistance. Despite solving a complex global health problem, the founder had to relocate the company to the United States just to survive, knowing they would never secure the necessary funding in India. The issue isn't a lack of vision among founders. Ambitious Indian entrepreneurs are fleeing to San Francisco and Dubai every year because an invisible hand is actively rewarding conservative, low-innovation business decisions. To understand why Indian tech is stagnating despite the record-breaking investment, we have to look past the pitch decks and follow the money back to its source. The term venture capital was originally synonymous with risk capital. In the US after World War II, this model funded unproven frontier technologies from university labs, ideas that traditional banks wouldn't touch. This approach was formalized in 1946 when Harvard Business School professor Georges Doriot created the American Research and Development Corporation, or ARD. It was the first modern venture capital firm. ARD took a $70,000 gamble on two MIT students who wanted to build a smaller, cheaper computer. The result was the PDP-1, the world's first commercial computer with a monitor, which eventually returned 5,000 times the initial investment. This is the core of the venture model. Investors accept that most bets will fail, betting that the few that succeed will create entire industries that didn't exist before. The modern Indian ecosystem operates on a very different logic. Of the roughly $35 billion flowing into Indian startups every year, 80% comes from foreign investors. This imbalance creates a specific kind of pressure. Foreign venture funds often operate on rigid 10-year cycles, meaning they need to see rapid valuation growth to justify an exit before their own fund closes. This timeline often clashes with the slow, decade-long R&D required for deep tech innovation. The result is a cycle of hyperscaling. Companies like Byju's are pushed into unethical growth tactics simply to inflate the valuations needed to satisfy the next foreign funding round. Relying on external money also leaves the entire tech sector vulnerable to geopolitical shifts. If a war or a change in interest rates makes foreign investors nervous, the pipeline dries up instantly, triggering funding winters that can wipe out thousands of jobs in a matter of months. Rented foreign capital behaves like a tourist. It is looking for a quick, profitable visit rather than planting the deep, domestic roots required for indigenous innovation. The remaining 20% of capital that is domestic doesn't fill the gap. Instead, Indian VCs often act like private equity firms, demanding immediate revenue plans and calculating strict internal rates of return before a product has even been tested. This risk aversion is a symptom of a missing layer in the financial system. In the US, venture capital firms are backed by massive pension funds that can afford to wait a decade for a return. In India, that institutional layer is missing. The Life Insurance Corporation of India manages $650 billion, nearly 54 lakh crore rupees, yet laws restrict them to low-risk assets like government bonds. This capital is effectively locked away from the startup ecosystem. Without access to that scale of domestic capital, even successful companies eventually lose their independence. When Flipkart reached a certain size, the lack of local funding options meant the founders had no choice but to sell the company to Walmart. Innovation has stalled because India's deepest pools of capital are legally barred from taking any significant risk. As long as India relies on a foreign capital pipeline, it will remain a consumer of global technology rather than a creator. One solution is a simple regulatory shift, allowing public institutions like LIC and the EPFO to allocate just 1 or 2% of their assets into domestic venture capital. This would provide the patient, long-term capital that deep tech requires. Universities can also provide a new source of funding. IIT Madras recently launched a 600 crore rupee fund specifically to back their own student and faculty startups at the earliest stages. Direct government support also needs to scale. Current programs like the SIDBI Fund of Funds provide about $1 billion. But to match the state-backed investment strategies seen in China, that number would likely need to increase 100-fold. Building a dominant tech sector requires a capital structure that can afford to take risks and wait for results. Until India directs domestic reserves toward original research, its ecosystem will continue to produce companies built on paper valuations rather than original inventions.